Hi folks, here we are. Welcome to the pre-show part of the show. Great to have you all there. Nice to see some familiar faces and some new names coming through too. Great to just spend a moment or two to give people a chance to get in the mood. Vanessa's hungry for some more DFA content. Well, it's coming up. Aaron, good to see you too. And yeah, there's an interesting question from Master Singleton about the new variants. We'll talk about some of the new variants a bit later too. Jason, yeah, we're doing all right. A lot going on. Hi, Patrick. Good to see you there as well. Nifi. Yeah, all good. So there you go. It's what's happened to unit prices in Sydney? Well, we might even touch on that. I don't think property is going to be in a major part of the conversation tonight, but who knows? We might come on to that a bit later. And so it goes on. Just going to run this for another 30 seconds or so and give people a chance to join in. It's quite interesting just watching the numbers rise. One of the other views I have here is let me just go to there you go, so I can actually see here what's going on the live stream now, and the graph is climbing nicely, so that's always good to see, and that also means that I remembered I can push that button, because I often set it up and then never use it, but there you go. Okay, right, I think that's enough waffle. Stand by. I'm going to run the start for the show formally, and then we'll get going. Here we go. Well, good evening and welcome to this live stream event on the 31st of August 2021. Martin North from Digital Finance Analytics here. Great to have you on board, and thank you very much for spending some of your Tuesday evening with us. This is greatly appreciated. This will be a really interesting conversation tonight. I've got Damien queued up and ready to go in a second, and just before I bring him in, I will just make sure that we go through our normal points, just to say this isn't legal or financial advice. Do please play nice in the chat room. The chat is moderated. I do encourage conversations, but no racial slurs, please. This is as at the 31st of August 2021 if you're watching in replay. If you want to get my attention, please use that Walk the World. That's the best way to make sure that I see what you're asking me. But obviously feel free to have other conversations in the chat too. I've also enabled Super Chat, which enables you to do two things. Firstly, to get your question top of the queue, but also if you'd like to make a contribution to help us run the shows, that would be greatly appreciated too. And with all of that, I think we are good to go. So let me bring Damien Klassen in. Damien, are you there?
I am, Martin.
Eureka!
Yes.
I always hold my breath. Great to have you on again. And 5 weeks ago we were chatting, it's now another month and a 5-week month for that matter. And boy, things are moving along quite fast, aren't they? I think a really good place
or slow if you're still in lockdown.
Well, if you're
the way you want to look at it. Yes.
Yeah, but you're absolutely right. I mean, the lockdowns are still here, and of course, probably will for some time. But I was thinking about 5-6 weeks ago, the markets were very much locked into the idea that the Fed would be tapering soon, that rate rises will be coming soon, and then basically Jerome Powell on Friday at the virtual sort of summit, as it were, basically quashed that and said, "Oh, not yet."
Yes. So yeah, absolutely. I sort of think about this. The Fed's in a great rush to do nothing. I think. Is that they're very busy rolling out the most hawkish members, I guess, to talk especially over the week before that. You got a lot of the people who are keener to raise rates throughout, talking about when we need to, we're going to, sort of calming the people who are concerned about inflation down, and then Jerome Powell comes out and basically takes the other side of that to sort of for the people like ourselves who are worried about growth, he's saying, no, we've got your backs. So I feel as if they're trying to give a message for everyone to say, if there's inflation, we'll sort you out. And then they roll somebody else different out to say, oh, no, if you're, but if you're worried about, the growth and that there's going to need to be this handoff, then we've got your back as well. So.
Yeah, it's interesting because I was speaking to Steve Van Meter this morning from the States, and he said, look, I've got this theory that Power's up for re-election in a couple of months, right? And that's probably something else that he's just sort of, he's just muddling through, letting time pass rather than actually being bounced into anything. But I'm quite interested. I've read 4 or 5 of the investment bankers' thoughts post Jackson Hole, and they've all started to turn much more negative, right? And it's partly the economic indicators in the US are not as strong as perhaps people were expecting. And of course, the Delta variant's beginning to bubble up and create some more problems too. And so people are now beginning to say, well, hang on a moment, these markets, they're pretty hot. Where are they going to go next?
Yeah, absolutely. And we've been talking a lot about this whole idea of this inventory super cycle that I've spoken about a couple of times on your show, which is that the idea that when, as retailers need to restock, they need to order more from manufacturers, and so because they need to replace the extra stock they've sold that month, plus they need to order a bigger order for the following month, and that means that there's this bullwhip effect where the next person has to order more, and the next person down the line has to order even more, and then it all comes to an end, and you get the whip back the other way, and all different commodities are all on all different time cycles for those. And we've already seen some. I think we've been speaking about the last 3 or 4 months. We've been speaking about the lumber price, and that's come full circle now. So it rose from sort of $400 or $500 a ton up to $1,800 a ton, and now it's all the way back down again. So back to sort of that 500 range. And that's exactly the type of experience we're expecting in a bunch of different other commodities. So I think there's, as you said, they're starting to fall in line behind that idea, and so. Really now the question as an investor is, okay, well, what's next? Where's the Fed going to? And I just need to be cognizant of, you're not trying to fight the Fed in terms of trying to do the opposite, but you do need to sort of be aware that, they're talking about a number of different scenarios and a number of different outcomes, and they don't know, the answer to it. And is actually saying, well, if I feel they're starting to head down the wrong path, like the taper path, where we were saying, we think there's this growth scare coming, and so. If the Fed does taper, it's going to be making a mistake. And so, you position your portfolio for that. And then as it changes, you sort of start to roll back to the and onto the next theme.
Yeah, very interesting. And, the fact is, of course, that there are some quite interesting indicators around, right? So on one hand, you've got, the S&P 500, which is going through the roof, right? It's hit another high today. We've got the situation, of course, where, wrong button. Push the right button. It'll help. Hang on. There we go. One of mine. Yeah. No, I'm a bit early on yours. Hang on. We'll come back to that. Let me push this one first. This is the, the 30-year, which is basically sliding back, right? So the rates are, the interest rate signals are perhaps a bit lower. And of course, the dollar index has come back too, but from where it was, it's come up a bit, and so we're seeing some interesting dynamics in terms of the dollar versus the other currencies. But my overall read is the dollar looks a little stronger than it was, and that's probably something that they'd be quite keen not to walk away too far from, because it puts them in quite a powerful position in terms of how the dollar plays into the international exchanges and all those things. So there's quite a lot going on, and yet if you look at some of the other indices, so some of the most recent job stats in the US were probably not what people were expecting. Some of the confidence stuff isn't what people were expecting. Some of the housing transaction stuff wasn't what people were expecting. So you've got this really mixed picture. Absolutely,
and I think there's, the big overarching sort of macro things you should be thinking about is that Americans got handed a lot of money, during the last 18 months, and then there's a lot more money coming in the form of infrastructure, but it's not here yet, and there's not another check going out to consumers there. So you're going to have this period of handoff where they've been funding effectively consumers, and then you're switching to funding jobs and growing the infrastructure side. And so in the interim, though, there's this problem about, is there going to be a bit of a growth scare? And if you believe what we're saying about the inventory cycle as well, and that inventory cycle coming off, then there is potential that you get to the stage where markets will sort of see that growth scare, and if they don't see the Fed sort of stepping in to add more liquidity to it, then you might. I guess my thought is you'll probably see the market fall until the Fed does step in and start to add more support.
Yeah, and something else I always remind people of, and I've been around this for quite some time, but September, October, if you look back at past corrections, they've tended to be at that time of the year. I guess people come back off holiday and sort of think again about what's going on, right?
Yeah, that's right.
I don't know whether
tax year considerations, and there's things like that sort of go into these as well.
Yeah, so statistically speaking, if it's going to correct a little bit, it could be correcting within the next couple of months. Maybe not, who knows? But on the other hand, then of course the other side of the coin is, well, they've just gone QEing, why not just keep going? There's no limit to how much they can quantitative ease. Okay, there's a lot of liquidity flushing around, the reverse repos are through the roof, a lot of it's going into the financial markets and asset booming, but does that matter?
Well, yeah, it's sort of I think we're probably on the right I think they will step up and put more money in, but the issue we have is it's a bit like, and I guess let's come back to the Australian situation, because it's probably a bit more stark over here for people who are seeing it, is we threw JobKeeper and JobSeeker and let people take money out of their super funds, and there was all this lending to small businesses, and when we stopped people from being evicted, and so there's all this stimulus got thrown at this problem a year ago, and then it all faded off. And now we're sort of ending up not as bad as what we were, because I think a lot of it was the unknown last time. But there is still a lot of pressure in terms of the jobs are coming off. There's a lot of people locked down and not spending on services, and the flow-on effects of that. And so and we have nowhere near the same level of support. And so it's the part about that just means the central bank has to do more lifting. And for me, that probably means you're going to have to see the RBA step in and possibly bring back some of these, some of the mortgage things that they'd rolled out earlier. So because it doesn't seem as if the federal government is going to do too much about it. And so and it's a little bit the case. It's similar. It's not as bad in the US, but it's a similar type of factor where they're not going to get anything else through more stimulus checks for people. I think there's very much that view there that, look, it's time to start reopening. I think if you look at a lot of the statistics that you're getting out of, even though the Delta variant is jumping, the limitations, how much that's limiting what people are doing is nowhere near what it used to be. I've probably said that in a really confusing way, but basically there's still people going to the movies. There's still people seeing sports and things like that, whereas 18 months ago there wasn't, and even in the places that were 12 months ago or 6 months ago, even the places that weren't locked down, people were self-limiting, and whereas I think you're not seeing that same case to anywhere near that extent this time around.
No, and there are a number of uncertainties. So the Delta variant is definitely reasserting itself, particularly in some states like Florida and Texas, for example, where perhaps they've been a little more liberal with some of their controls or lack of controls. And then, of course, more broadly, we've got the South African variant, which is not looking particularly positive. We've got Indian stuff. So there are various other flavors of the virus out there as well. And trying to decode some of that and factor that into your thinking is pretty complicated.
Yeah, absolutely. So I think from the what gives me a little bit of, I guess, comfort from the virus perspective, from the Indian virus, from the Delta, is that this strain has been through India, and there was a rise, and there was a jump in deaths, and then a fall back down again, and there's obviously a low level of that sort of circulating throughout the Indian economy still. It hasn't fixed it, but they've had their peak, and all the pictures we saw of hospitals, and they're through. They're sort of, I guess, it's burnt through the population and it's out the other side. So I guess where I'm coming from is saying it is so virulent, and it does rip through that population. And it is a question about deaths versus opening up or closing, and people's mental health and monetary issues and things like that. And for me, it's about saying, well, have countries reached a stage where they're probably just going to get on with it? We put up every day with the fact that we can die in a car accident, we can die of cancer. There's all these different things that can happen. And obviously, when it first happened, there was a lot more concern because it was killing a large proportion of people, and we didn't know. There was just stuff where we didn't know how bad it would be, and we didn't know what would happen. I think now, after 18 months, people have a much better feel for the risks. We have a much better feel for people who are vaccinated, obviously, which is now the majority of people. Now can feel that, well, yes, I might get it, but if I do get it, there's the chance of me actually ending up in hospital is very, very low, and the chance of me dying is extremely low. And so I think from that perspective, there is this element of let's just get on with it. I think Australia has got a problem though, because we did so well in the early stages that we haven't sort of been through that acceptance stage that a lot of these other countries who have basically been facing the virus, with an ongoing factor basically ever since it started. And so, whether that just means Australia is one of the last ones to come out, it's quite a. This is all speculation, but it's quite an interesting dynamic that you could see the way things are going at the moment. That we get New South Wales vaccinated to a certain extent, and they start opening up, and there's lots of people. Hospitals still being overrun, and there's lots of issues there. But they've basically said, well, that's it. We've run up the white flag, and we're not going to try to get rid of it anymore. And you might find a lot of other states lock the borders to New South Wales, but then New South Wales starts, people start traveling again, and they're going to the US, they're going to the UK, they're living normal lives, they're getting on with things. And then it's the pressure on the other states to at what stage do they open up? And so, I think given a choice, I don't think New South Wales would have liked to have been in this position. But given they are in this position, that seems like the most likely course at the moment is what they've been talking about is, yes, it'll be very bad throughout hospitals, and it's going to grow, and it's going to get worse, but they will open up. And then once they're open and vaccinated, well, why not travel to the US? Why not travel to the UK and other places? So,
well, it would be really weird if people from New South Wales were more able to travel to the UK than to Perth.
Absolutely, and at the way things are going at the moment, that looks likely. So yeah, absolutely.
To redraw the boundaries.
Yeah. Now this is a second South African variant, isn't it? We're talking about, not the first South African variant.
Correct. So it's the new one that's they've announced it over the last couple of days. Couple of characteristics. One is that the virus avoids some of the antibody protections that were actually designed into the earlier versions of the vaccines. So in other words, the vaccines will be less effective. It's also very, very virulent in terms of transmissibility. So it's worse than the Delta variant. So, and
I don't think they haven't got much of a read on the mortality rate, though, do they?
No, it's too soon.
It's always
too soon.
Hard part. Yeah, so because in a way, if you can have a version of the virus that is more virulent but gives less mortality, is actually sort of a good thing in that sort of crowds out some of these other viruses, some of the other variants that might not be as virulent, but they're more deadly. And so that part we need to watch, I guess, and work out how bad it is. So I don't want to jump either way on that one, but if it doesn't make a big difference to the mortality rates, then that really doesn't change our view on that. There's a lot of countries out there that are just they're done with it, they're over it. The vaccine reduces it to a low enough amount of death that it's an acceptable risk, and they're just going to move on with life. I think we're sort of scanning newspapers and checking for a lot of this stuff in various overseas ones, and it's pretty much disappeared from a lot of the newspapers from the UK, for example. Yep. It's just gone from being a front page story to the front page of every single page on it, like it pretty much is in Australia, to it's a bit more of an afterthought in terms of it, and I think that's the way it will go eventually. It's really just a question of timing.
Well, it's interesting because I've got a lot of contacts and relatives and friends and family in the UK. and their attitude is completely different to what we've got here, right? So, they've been exposed to the whole process for a lot longer. They've seen much higher levels of death and hospitalisation, and in fact, the numbers are rising, or the deaths aren't rising as quickly. But basically, it's not news anymore. So, very different from how we're reacting here and in New Zealand. Yeah,
exactly. And I think there's that. It's obviously there's this. If you're told you're about to die from something, or there's a real danger out there. Look out, Martin. Every time you go outside, you might die from this thing, and you're like, okay, I've got to keep an eye out. And every day that happens for 18 months now. Eventually, you go, well, they've been telling me that for the last 18 months. I haven't died yet. Oh well, I'm just going to have to get on with it. Whereas I think in Australia, it's been like, well, you're about to die. Oh no, that's fine. We've got rid of it, and everyone can just relax for a while. We haven't been through that same process, and it'd be interesting to see now. But we have been through a lot of lockdowns and a lot of. So I think it would be faster. It won't take us the same amount of time, but it does seem like it'll be delayed relative to other countries.
Yeah. So there are a lot of things I wanted to touch on tonight, but one of the most interesting is the recent Bloomberg article. And shall I put that chart up, and then perhaps we could use that to start a bit of a conversation about this particular wonderful concept, right? The liquidity alarm, or the negative Marshallian K. Now, this is one that you suggested we chat about. Really interesting.
So this was similar. You'd had a. We'll talk about again about money velocity, but this is one of those ones where really what it's trying to track here. I wanted to flag this one as being another one of these things that's got a funny base effect, really. So you can see on that chart, there's like right at the end there that we've got this one negative read, but just before it, there's like 4 really, really high numbers. And the reason why is because this is a chart that basically looks at the change in liquidity being offered by the Fed versus the change in GDP. And so what's happened is in those 4 quarters before this last one, the Fed was throwing all this extra money into the market, and GDP wasn't growing very quickly. So it was basically there was liquidity growing at 20% faster than what GDP was growing at. And then this last quarter, we've had GDP grow faster than liquidity. Now, the reason why is basically it's a low base effect is we're just looking at that worst quarter from a year ago, so the GDP growth looks really good. And the other thing is the levels are all really, really high. Like the Fed's already thrown all this money at it. And so on a year-on-year basis, that hasn't grown, but it is at a really high level. So I look at these types of measures and say, okay, they're interesting insofar as looking at what's going on, but particularly now we really have to be wary of base effects and the worry about looking back a year ago at really bad numbers. Whereas if you run it back 15 months rather than 12 months, all of a sudden the numbers actually look a lot more reasonable. And if you run that back 15 months, you get much higher numbers on that.
And that is the point, right? There's still a lot of distortive effects in a lot of the reporting that's going on at the moment. And, we've discussed this before, particularly with some of the inflation reads and some of those other numbers, which sort of, begs the question then about some of these other metrics, right? The one that I think is quite interesting is the velocity of money. This is the velocity of M2, right? And you can see there that basically up until 2020, it was sliding down, and it's dropped dramatically, right? Now, a number of people are basically saying this is horrendous because basically what this is showing you is how long it takes for a dollar to go around the system, as it were, right? Which suggests that there's a lot of dollars out there, but they're not necessarily actually going around and doing anything effective in terms of economic output. And that's a problem. So they would argue, therefore, that the quantitative easing program has completely failed in terms of its ability to drive the economic momentum that the Fed was trying to do. Now, there are some issues, though, with looking at it like this, aren't there?
Absolutely. So my issue with this is that what you're seeing there, in a way, is just the inverse of what the Fed is doing. Is that's I think it's the GDP on your monetary base. And so all you're doing is growing this base, growing all this extra money and throwing it into banks, and banks are putting it in their reserves and not spending it, and all those issues we spoke about. Households are saving it and all that type of stuff. So the money's all sitting there, but nobody's out doing anything with it. And so, look, that's a bad thing in some ways because yes, we did want that money out there to be circulating. It would help, but it's not signaling a doomsday because what because there is so much money out there, if that velocity increases just a little bit, the actual volume of money will be significant that flows out there. So I don't want to say velocity of money in itself is not an important thing. It is an important thing, and the more that people are out and spending that money is important. But I guess what I'm saying is I think that measure is distorted, particularly by banks, by what banks are doing. That it's not as useful as say a household savings rate or something like that. I think will actually give us a little bit more of a I don't know what do you call it, an accurate read, or it's not a perfectly accurate read, but because there's other factors that go into that as well. But at least it's giving us a bit more timely read than that I think again has just been distorted by what the Fed's doing and then what the banks are doing on top of that.
Yeah. So the point about velocity is it's got to take some account of how much is in the system and being thrown into the system, right? And because more and more stuff is being thrown in the system, it's going to take a lot longer for that dollar to come back round again. Right? That's how I think about it, right?
Yeah, and it might be that there's whatever, I don't know, $1 trillion out there circulating, and 10 years ago we had $1 trillion out there circulating, and 500 billion sitting in bank accounts not doing anything, and now we've got 1.5 billion sitting in bank accounts not doing anything, but we've still got $1 trillion out there circulating. And so, that in that sense, the velocity of the money that's circulating hasn't really changed. But I guess what I'm saying is I think that's a flawed measure.
Yeah, absolutely. Now, here's another flawed measure, which I think is quite interesting. This is the margin accounts, basically. So it's the leverage, right? And people are saying, well, look at this, massive amounts of leverage in the system, 600 billion or whatever it is, right? Massive amounts. And that means a lot of people are taking speculative positions on the markets. And that's another risk sign, and that's going to all come unscrambled again. Another reason why, effectively, things are looking pretty wobbly. But again, I think we need to be careful of base effects with this one too.
Yeah, absolutely. So this one, I think this one's, if you divide it by the GDP, the market capitalization of the market, then it doesn't look as bad. It still doesn't look good. It's still getting high, but it's not sort of red light flashing and siren sort of going off, telling you, look out. But it is starting to get up there in terms of the margin lending. So there's still a bit more scope, I think, on that. We look at that. We look at the options markets, and that's sort of showing some similar signs, because that's effectively like what we're concerned about is leverage, really. Where are people investing in stocks with leverage, because they're the ones when markets do take a bit of a tumble and down sort of 5% or something like that they end up being forced sellers, which then push it down to 10%, which then uncovers a whole bunch more people who then and that's when you get those spiral and you get the really quick downward measures when people are out there using leverage. And so I think of the options market as leveraged as well. It's often not the people who are actually buying the options, but sitting behind it. There's people out there doing the market making and everything like that, and they often will have sort of leverage positions. And so, so the big issue is within those markets is when it all comes unstuck at once, and options are really high. So option volumes are really high. Margin volumes are quite high, but not sort of extreme. I guess the question is, how much further can we push this? There's still household savings are being run down as people are starting to spend. So I guess where I'm getting to is there seems like there's probably a little bit more scope to push those higher, but we're getting close to the as high as you'd reasonably expect those to go.
Right, and I think probably you and I have a slightly different view. My view is we've got to the point now where there is just so much being pumped in, right, with nowhere to go. They can throw another, 120, 100, 200, however many more billion into it. But actually, it's getting to the point now where it's just stupid anyway, right? It's not going to go anywhere, right? It's not going to fundamentally move into a different domain, right? And in fact, Vanessa asked a question a little while ago, which is America heading towards Japanification, right? And, if you play the story of Japan, well, they've had 30 years of lower and lower and lower rates. The central bank of Japan buying more and more and more of the economy. Growth is still very, very sluggish. Now, if you talk to people in Japan, they don't feel too bad about it. But if you look at it on the normal metrics, it's pretty shocking.
Bad. Yeah, so there's a few things in here, and this is the opposite of the Australian game. The Australian game is you grow your GDP but you grow your population faster, and so people actually end up worse off or the same. But whereas Japan's had a little bit the opposite, is they've had a shrinking population, and so if you just look at say GDP, things look really bad. If you roll back and look at GDP per capita, and even take it one step further and look at GDP per working age population, because they do have such an aging population, then all of a sudden things don't look as bad. And I think I saw one about a year ago that had Australia at the top of the table with 1 and Japan at the bottom. And then you took into account those factors, and it didn't quite reverse. Australia went to the bottom, but Japan sort of went to, 3/4 of the way up in terms of reversing positions. So, do I think America is in for Japanification? A light version of Japanification. I think China's in for it. There's a lot of Europe is in for Japanification. US has got a couple of things going for it. Traditionally, you'd think ordinarily it's got a couple of things going for it. One is a younger population and more propensity for immigrants. Well, they certainly used to. I guess now, in a post-Trump era, there's probably less, but there's still more scope, I think. There's probably the biggest factor though is traditionally the US has been more than happy to let companies go broke, and that's probably one of the things that in China, in Japan, didn't really happen. The debts just sort of all got bundled up and shared and switched around, and good companies bought bad companies, and everyone just sat on these huge amounts of debt for roughly 20 years. The companies. It's interesting. Japan now, some of the companies are actually just getting to the stage where we're looking at them and going, actually, these are looking pretty good now. They've actually they've got their debts down, and they're back to something where they can grow at a reasonable rate. So that was Japan dealt with it that way. Europe seems very likely to deal with it in a similar way, and you just bundle everything into bad banks, or you tell the banks that give them negative interest rates and keep them going. And China is almost definitely going to be down that route in terms of they're the experts at bundling things into bad banks. That was we'll divert back to Hurong in a minute. I'm not sure if I pronounced it right. But the US tends to be more likely to let the companies go broke and then go, okay, let's pick up the pieces afterwards and go on with it. So if the US does go down that route and the traditional route, then I'd say they're less likely to end up as Japan, and they've got a more aggressive central bank as well. But if any of those start to sort of fade back as the central bank is a bit more conservative, and you get a bit more, well, let's bail this company out and let's keep these rules in to not let companies sort of go broke, then the US is headed for Japan.
Yeah, and the point about that is there are some demographic things happening in Japan ahead of other countries. If you look at the working population, it's down relative to the total population. It's beginning to happen in the US, and a number of people say to me, well, actually, if you compare Japan, the US and Australia, our demographic profile is actually a whole lot better. And you mentioned why, because of course the strong migration we've had for a long, long time, and guess what, they'll probably open the doors and bring more people in, because that's basically the only quantitative easing leader I think they've got, frankly.
Quantitative peopling, we're calling it.
Quantitative peopling, I like it. Yeah, exactly right. Yes. Yeah. So, but in a way, that's what they've been doing for the last decade plus, isn't it, in Australia? They've used the population growth to bolster the GDP. As you said, GDP per capita not going the same way as GDP, but actually in the aggregate numbers, bring enough people in. If they spend enough, hopefully, some of them will get jobs as well. That's enough to then keep the economy growing, even if you get congestion and pricing on houses goes through the roof as a result.
And partly because you bring more people in, you get more income tax revenue. So as a federal government, it's good, and all those other problems you spoke about, they sound awfully like states' problems, which don't have anything to do with the federal government. So, okay.
Very, very convenient. Nothing to do. And it's exactly, of course, the same. You notice that the current inquiry that the federal government has launched on housing affordability, right? Which is all the supply side stuff, which is nothing to do with them. It's all state again.
I know. Again. We just do it. We do it every few years. We roll one out.
I know.
And we come up with all the same solutions we did last time, and then we ignore them. Go back to giving first home owners grants. I don't know.
Don't mention the debt.
Yeah, I must. Sorry, I cut you off before you asked me a question, though. But cause I sort of I haven't really been paying that much attention to this so far because I'm a bit jaded of the whole thing. To be honest, I don't think they're going to come up with anything.
No. This is a classic misdirection in my view, right? You know, everybody knows that there are votes in actually saying they're doing something about affordable housing, right? And so the government can then say, well, you know, we've launched this inquiry and it's all to do with the state supply of land, you know, all the normal stuff they always play. The fact of the matter is the main reason why house prices are so high is because the lending standards are too loose, the debt's gone through the roof, people can borrow a lot more, look at all the debt ratios, all those sorts of things. But that's not something they want to talk about, right? Because basically the two levers we've got at the moment, one lever is population growth. Well, that's dead because we've got the border shut at the moment. The other is get more people to borrow more. And that's another lever for growth. So that's basically what they're pushing, right? Which is why, of course, Frydenberg is saying, well, you know, we want ASIC now to be part of the growth story. Hang on a moment.
That's right.
The regulator, the people who are meant to be looking after the conduct of the banks are now charged with encouraging growth.
More importantly, it's the people who are meant to the brake. They're basically saying, you guys are meant to the brake. We don't want to use you as a brake anymore. We'd like to turn you into an accelerator. It's like going, just a minute. Doesn't that, isn't that the whole point of the regulation? Yeah.
Well, the whole point of regulation is it's meant to be leaning into the problem rather than actually reinforcing the problem, right? So, you know, I don't know.
Absolutely. So, I mean, it was interesting. We were tossing this around the other day, and I'm still exploring this and stretching it out as a mental model for this. But you know, it really occurred to me looking through what China's doing, and so China, for anyone who's hasn't sort of been watching, is really slowing down in terms of what that's and the reason why they're slowing down is because the industrial sector is actually booming because everyone's still buying products and there's supply shortages and everything like that, and so. And what they did was they used the property sector coming out of the coronavirus. They threw all this money at it to really get the construction going, and they threw a lot of money at that and infrastructure. But that's now all slowing down, and there's a lot of noise coming out of China talking about restructuring their entire system there. And they've known for years, for decades, that this is unsustainable what they're doing. They tried in 2012 to try and fix it, and then things slowed too quickly, and they put it all back on again. They tried in 2015 again, and we had this whole commodity crash at the time, and same thing happened again. Things got too slow, and they went again. They tried, I think, in 2019. We didn't notice that one as much in Australia because at the same time we had Brazil, a whole bunch of mines go out in Brazil, and so the iron ore didn't fall as much. And so, but you know, it was a similar in terms of most other commodities. Now they're trying again, and they do seem to have a fair bit more, I guess, intellectual support behind this in terms of saying, look, we let people get rich, and now we want it to be more equal. And so, and they're going through and they're going, oh, what do we need? We need property taxes. We need less speculation on property. Houses should be for living. You know, you go through all these things, and they talk about the property is such a large part of the economy and it's driving the economy, and saying, no, we actually need productive resources. We can't be just sitting here trading houses to each other. And every single one of those problems is exactly the problems Australia's had, and we're not going to talk about that at our property one. It'll all be about, you know, as you said, you know, how do we blame the states for various things, and so we've been putting together this sort of mental model in terms of saying, well, are we actually really running three different arms of policy at the moment? We're running, and same as in China, you have your monetary policy where you're moving your interest rates up and down, and trying to influence your exchange rate and trying to bring your borrowing rate down for companies. But the side effect is that you also bring your borrowing cost down for consumers, and they go out and leverage it all up and go and buy houses with it. So that's one part of the monetary policy. Then you've got your fiscal policy, what you're doing in terms of government spending. And then the final part is the property policy. How are you actually managing that problem that interest rates are so low that property prices are booming? And that's drawing all the good resources, all the things that we should be out there, you know, solar power or semiconductors or space exploration or whatever it is, whatever new things that are actually going to add productivity rather than trading houses to each other. Is Australia sort of gone, well, no, we're not going to bother with that. We'll just let house prices go. Whereas China's trying to do something about it at the moment, but looking country by country, it's a question now of we think that given the way asset prices are going, that's probably just as important in terms of working out what the economic effect is, because some countries are just going to say, well, we'll just lower interest rates and we'll live with the fact that asset prices are just going to boom and property people will get rich, but the society as a whole won't. Whereas other countries are going to say, no, we actually need to rein that in and make sure that this extra money isn't just being geared up and put into trading houses between each other. It's actually being used for something productive.
Well, it's an interesting comparison to Australia and New Zealand, right? Because New Zealand basically in the last few months has started to change tax slightly. So firstly, they gave the new Reserve Bank in New Zealand a specific accountability with regard to the impact on monetary policy on house prices, right? They now have to think about it, whereas previously they didn't. Whereas in Australia, both APRA and RBA say house prices, nothing to do with us. We don't even think about it, right?
As you just said then, like New Zealand's come out and said, hey guys, it's your job to make sure house prices don't get too high. And Frydenberg's turned around to ASIC and said, can you make sure house prices get higher?
Exactly. Yeah,
we've actually had the opposite case. Yeah.
Exactly right. And then what they've done is they've started to put in place some more hurdles for lending in New Zealand, so that effectively investors in particular, they've tried to sort of crimp investors a bit, and they're talking now about additional interventions in the marketplace to try and cool the house price growth, which I think above 22% at one point, in fact more in some areas, right? So massive rise at a point where in New Zealand there is net negative migration rather than positive migration at the moment. So in fact there's less demand, and there's still a lot of construction going on. So it's interesting watching that. Then if you look at the UK basically is again experiencing very, very strong house price growth, and whilst they've got a few checks and balances in place, they're letting it rip at the moment because it's basically the only game in town, right? So that's an interesting comparison. So in a way, you could say that if New Zealand's at one end of the spectrum, the UK is somewhere in the middle. We're right at the other end of the spectrum because basically we're pushing that lever as hard as we absolutely can. Right, 3 billion went into housing from government stimulus packages to now allow people. 3 billion. That's a big number, right? That's a lot of money. To allow people to get into the market and buy off the plan, all those things, and first-time buyer grants and things.
And a lot of $10,000 amounts withdrawn from super for exactly that reason.
Correct. And the problem there, of course, is now they've got this bottleneck of people who can't build because they can't get the resources and they can't get the materials, and the costs are going through the roof. And yet, guess what? Now the construction sector is saying we need more of that, please.
Yeah. Well, that's part of that. I'm sure this review they're doing of the housing market will give them enough cover to roll something else out to help that. But it's an interesting thought as well, and I guess it's like we've spoken about this a few times, is that we've got sort of 10, 11 million households, don't we? And whether and so that sort of works out to whatever 2.5 or 3 people per house. Where that turns from 2.6 into 2.7 makes far more difference than if we actually build a whole bunch more property within a year. It's like that. Yep. That's your real swing factor. And I'd be interested in knowing whether you've seen in your stats at all the number of people with second homes or who are saying, you know what, I'll have a place in the city for when I have to go to work and a place in the country for when that's not locked down and one is locked down, or vice versa. I don't know whether you're seeing increases in that.
So I've got quite a lot of data on that. So there's a few things to say. Firstly, in the last year or so, we've seen more younger people going back and living with parents, right? And that's partly because they were in rented accommodation and they couldn't afford to pay the rent, or they were not working, etc., etc. So I wouldn't be surprised to see the census data when it comes out later in the year showing an increase in the average number of people per household across the country as a result of that, right? Which would be interesting. That would be the first time in about 30 years if that happens, because actually, if you look at statistically speaking, over the last 30 years, there's been almost no change to the average household composition in the ABS surveys, in the census surveys, right? Over that period.
And even with falling birth rates.
Even with falling birth rates, et cetera, it's been roughly static, right?
So basically you have fewer kids, but your kids stay longer. So the whole thing works out.
And that's because first-time buyers tend to buy when they're in their 30s rather than their 20s now, et cetera, et cetera, all of those things, right? First point.
Yep.
The second thing that's really interesting is we know that there are a lot of people who have multiple properties, right? Mm. And they basically have one where they've got their sort of the main base, but they spend quite a lot of time, down the coast or wherever it is, right? And the characteristics of where they've been living in the last year or so has changed dramatically. So whereas previously people would have said, well, I live in Sydney and I occasionally come down to the South Coast, say, now they're saying, well, I live in the South Coast and when I have to, I go up to Sydney.
Yes.
Now, that's a combination of, the lockdowns and the virus and everything else. But that has fundamentally changed. Plus, NBN, working from home, working remotely, all of those things. That has really tipped the balance. The other thing, of course, there is that people have now started looking at Queensland rather than Victoria or New South Wales. So quite a few people now have been buying in Queensland and frankly not paying that much relative to Sydney or Melbourne prices. So they got a place up there, and that basically is becoming, at some point, that will become the place they will spend more time there when the borders are open, if the borders are open, right? And people are actually still buying sight unseen of properties up in Queensland even now. And the latest ABS statistics on migration between states show the net drift away from Victoria, New South Wales, Sydney and Melbourne to Queensland. It was actually quite strong.
And so that sort of sounds as if where I'm feeling that the stats are going is that, as you said, we're ending up with more people living in a smaller amount of houses, and then a bunch of people who have two houses.
Correct.
Who are living between them. Yeah.
Correct. That's exactly right.
Yeah.
And then the third factor, which is interesting, is that if you look at the older population, so those post-retirement and perhaps getting a little infirm, there is a very strong trend now not to go into sheltered accommodation and not to go into privately run aged care facilities. They much prefer to go back and live with the family.
Oh, okay.
Right? Now that, again, has been really exacerbated through the virus over the last year or so.
Yeah.
So it'll be fascinating to see to what extent those trends come through when the census is reported later in the year. I'm expecting some significant shifts. Yeah,
it's an interesting one, isn't it? I've got to think about that one for a bit more.
So what it basically says is you've got higher levels of multi-generation occupancy in one property, and that's one reason why some people are buying bigger places, right? Because they want the granny flat or the extra accommodation for other parts of the family. Right? Yeah,
well, or people need a study, or they have one study, they need two studies, and absolutely, that's more that thought for. There's a structural change that's needed, and
the interesting thing about that is that's having a profound impact, particularly in some of the regions, in terms of house prices, demand. A lot of locals are now being priced out. So down here in the Illawarra, a lot of locals cannot now buy unless they go a long way south because it's too expensive. So there are some really profound things going on, which I think probably are not just temporary. I actually think these are structural. And I think it will change the dynamics of the housing market in many different environments for quite some time.
Yeah, absolutely. But it's a lot of it's that part where particularly even more so for regional areas, I guess, than the cities, it is a choice about development and land in that we have so much land in Australia, relative to our population. So you could jam. I can't remember doing the stats once. It's along the lines, if you gave everyone a half-acre block, we could all fit into the ACT or something like that.
Correct.
Where it is we're in this really big country, and when you look at a regional town, there's no particular reason why you should have to pay massive prices, other than that they keep the land so that it's
controlled, of course,
it's
and that's
controlled.
so that definitely is part of the story. And it's interesting. There was a report came out, I think it was today or yesterday, that said if you look at a new building, right, there's about $80,000 worth of costs on a new build that's to do with what you have to pay to the council for infrastructure, right? And previously that would have been paid for directly from the council as part of the infrastructure development in a particular town. Now, new property purchasers are having to pay for that pretty much directly. In other words, the funding model has changed dramatically.
Yeah, and there's a good argument for those ones. I mean, that's what I'd love to see here. It doesn't bother me as much that you're doing that in terms of wanting them to pay, but I think a lot of other countries, particularly in the US, will say, okay, well, let's put some 20-year, for the next 20 years, you have to pay $1,000 or whatever, $2,000 a year in extra taxes or to actually pay off the loans that we've done to do that, rather than a massive upfront fee that then get built into the price of building the property. So saying let's make it an ongoing cost and spread it out over a number of years.
And of course the industries associations, and I would argue that that's one of the reasons why property prices are so high. It's a structural problem again in terms of the way that infrastructure bill is actually being recovered.
Yes.
And is it appropriate that the purchaser of a new property pays the $80,000 to be able to actually connect it to the roads and everything else, or is that not appropriate? And those are the sorts of things they should be discussing in this inquiry, but I bet they won't go near them.
No, absolutely. Well, let's hope. Let's hope.
I've got my fingers and toes. I should be making a submission because I'm just so cross. But I could almost dust off the submission I made 5 years ago and 10 years ago and say what I said then. Just read this again, right? Because nothing has changed.
Times two.
Yeah, exactly. It's just a political football. Now, here's an interesting question for you. This is one that came up a little while ago. I noticed you sold off a lot of stocks in the Nucleus Diversified portfolio this week for cash. Are you expecting a dip?
I don't know if it was this week, but actually, maybe sold a little bit. Look, we've been selling for the last probably month and a bit. We've been raising a bit of cash. So, look, we've got concerns over a growth scare. Actually, initially the concerns as well was that the Fed might taper was one risk, and we thought that would be policy error. And as we said, I'm going to say every time I come on the show is that we're in this market driven by central banks, driven by governments. The biggest thing we have to worry about is policy error.
Yeah.
So there's that. The signs of slowdown in China, I don't think are well recognised yet. So we think there's probably the most likely scenario I could see at the moment is following something like the 2015, where China started to slow down, went through this whole process of, yes, we need to diversify away, we need to get more into away from the housing market into other industries. And they did it. Commodity prices crashed. They slowed down too much, and then eventually just went, okay, that's fine. Let's throw more money at it. We expect it to be similar. My concern is that, or I had a concern, a few months ago, was that maybe China had stamped the accelerator a bit more quickly this time because they've seen it a few times and they just wouldn't let it slow down. But I actually think the case, it might even be the opposite. All this stuff we're seeing coming out about cracking down on kids playing computer games. Well, that's probably a minor one, but it's more. It's things like the housing stuff. They're trying to do the housing market. They really have put the clamps on the debt in terms of developers. So developers have got these 3 red lines they're not allowed to go over. They're cracking down then on. So as they did that, they put on these rules for how developers can't get all this extra debt. So then, as any good capitalist society would do, is private equity all of a sudden goes and creates these new types of securities which end up just looking and smelling an awful lot like debt, but not being called debt. And they've cracked down on those as well. They have the local governments. I mean, they did the local governments back sort of maybe 5 or 6 years ago now. They used to basically tell they'd tell the banks go and lend to local governments, and they'd have all these bad debts that crop up. And then, so what they did was they reformed the sector, and now the local governments actually have to go out and raise bonds, which then puts that bit of market discipline around it's not, you can't just do it and spend it on anything you want. You actually need to have some sort of idea about how the bondholders are going to get their money back. So there's a lot more disciplines have been put into that, which means that they're slowing that debt sector down. I spoke a little bit about, I can't pronounce it properly, but Hurong, which is basically this was a bad bank. So basically when problems went wrong, I can't even remember what year this was from. I'm going to call it from post GFC, but it might have even been from earlier from that. They bundled all these bad debts into this one big entity, and this entity turned itself into a hedge fund and started borrowing, and now it's going to fall over because it's basically been leveraging itself and taking on all these extra, basically, one of the guys got executed, one of the leaders got executed because they're basically taking bribes from people, saying, well, if you give me some money, then I'll go and buy all your debt and solve your problem type thing. And they've cracked down on that one. Like, it does look like they're systematically going through and trying to really rein in some of the excesses and do what they're saying that they're trying to do. So I have a suspicion that what will happen is, I don't know for certain, I don't know when we might change our view at any time, but at the moment it looks like China is genuinely going to slow down quite a lot, and really try and make some genuine changes, get more, particularly more IT and more semiconductor. They're trying to bundle as much resources into that. They're trying to bundle resources into renewables. They're trying to bundle resources into healthcare. Like they're trying to take away in their education. They've banned the amount of they've banned all the tutorings, all these companies that do after school tutoring, because they found it's a bit like private schools over here, is that all it is turns into an arms race of who can spend the most money, and people get guilted into spending all this money for what appears to be not a very big change in the level of education. And so they're trying to pull that back and go, well, let's ban that so that we can end up with a more even society and less wasted resources. And so so at the moment it looks genuine, and until we start feeling that no, they're just going to turn around and go back to the old model. One more reason to keep out of Australia. So what you would have noticed, we sold a lot of Australian and picked up a lot of international, which has been very much the trade, particularly the resources side has been weak in Australia. So.
Right, and of course the iron ore price has dropped from above 200 down to 150, 160, right? Directly off the back of what China's been doing.
Yeah, absolutely. And the interesting thing for the iron ore price, because it moves so quickly, is last time when it went to sort of $200, it rose a lot more slowly, and so and there was a lot more faith in terms of the resources market that this was a boom that was going to last for a long time, and you even had the Australian RBA talking about 30 and 40 year booms. And so what happened was there was a whole bunch of mines all got created and started all the way up the cost curve, and some of them were just even trucking, like they didn't have trains, they were just trucking the iron ore such a long way because they could dig it out of the ground for $60, but then spend another $70 actually getting it to China and still make money on it. But then what happened is as the iron ore price fell, what you'd actually have to, as it would fall, you'd have to fall far enough that someone would take supply out of the market. So the person who's had $150 costs, the price would fall to $130, and then eventually they'd go, right, that's it. I can't do it anymore. They'd go step out of the market. Then it'd fall to $120, and the person with $140 would drop out. The issue now is all the suppliers don't have $150 costs. They've all got like $30 and $40 costs, because that's where we were just a few years ago, and there hasn't been enough time to come on. And everyone knows how much extra supply that Brazil's bringing back on to replace the supply it has shut down in 2019 and 2020. And so nobody's built this extra stuff, which means to actually get iron ore volumes out of the market is going to need a really big drop in the iron ore price. Probably well below $100 just to get iron ore out of the market. Probably closer to $50. Very interesting dynamic there. It's not the same type of price fall we saw coming out of the GFC, because the run-up's been so quick. It's quite likely that the fall will be just as quick if volumes keep going the way they're going at the moment, which, as I said, it's got all indications it will. The opposite, I want to disclaim myself though as well, is if China turns around tomorrow and says that's it, more debt for everyone, then then it's back on. But at the moment, it doesn't look like that's happening.
And the $50 to $70 range is definitely on the cards if in fact it plays out as you're suggesting, which is basically China continues to tighten what it's doing, because as you say, the cost of production is just not that high. I mean, they've been making excess profits, right? Which means, Brazil, of course.
Sorry, I was going to say Brazil's got another. It had 100 million, I think, at the start of the year. It's probably only got maybe 70-something million to go of new production it's bringing on. That it was production that shut down, and it's some of the highest grade production out there. So it's very low cost.
Yep.
So.
Yeah, well, Zach iron ore exports have dropped. How low will they go? Well, 50 to 70, I think, is quite sustainable. But if that does happen, then that's a big deal, right? So if you think about how much of our economy has relied on the excess profits from iron ore, it's been 68% of total contribution, I think, to exports. The last time I looked, a massive amount. Yeah,
well, look, it's interesting as well how much ends up in the economy. Nobody really knows, but because BHP and Rio are substantially owned by foreign investors,
yeah.
So that sort of makes a difference. The people who do own a lot of shares tend not to be the type of people who, if they get another $10,000, $100,000, they rush out and buy something with it. You tend to be rich people, so they tend to save more of it or reinvest more of it. I think so. Within that market, a lot of it really gets recycled back through tax receipts. Is where most of it, and that sort of comes back from the rivers of gold or rivers of iron ore that turn into gold, that come into our economy and allow us to do these. All these budget projections they made, some of it was badly made and badly calculated, but some of it was that the iron ore price suddenly shot up and all of a sudden we've got all this extra money. And so as that comes off, that's where we'll see the penalty in it. And unfortunately, Australia tends to be very good at making longer term commitments based on shorter term rises in the iron ore price. Last time it happened, there was pre-GFC, there was a whole bunch of things we did about whether we're taking taxes off superannuation and people in pension mode and middle class tax cuts everywhere. And then 2012, there's another bunch of tax cuts and things that were put in place. And this time we've gone out and spent and put through another batch of tax cuts, all based off, iron ore price shooting up to $200 and then falling back down to 50, and the money that was going to pay for it's no longer there, and so we go back into deficit. So, you only have to look at Norway, for example, as in a very similar situation to Australia with the oil price, where they take all the excess profits they make and throw it into a fund and use that later, as opposed to taking the excess profits when they happen and ploughing it back into permanent tax cuts for everyone.
Absolutely. And Nicholas asked the follow-up question, which is, any correlation with iron ore prices and the real estate market in WA? The
Absolutely.
answer is just a bit.
Yeah,
right?
Absolutely. So sorry, I'm being too East Coast centric here when I'm talking about it's not coming back into the economy. WA is definitely the exception, because there is the employment. It goes into the employment market. The average wages in WA tick up when you get it coming through because of the demand for people to work these mines. But less so this time, though, having said that, because there hasn't been anywhere near the same amount of development. As I said, it's mainly been people trying to get as much as they can out of existing mines. Obviously, if you've got a $50 cost and price of $200, you want to get as much as possible out as fast as possible. So there's a little bit of that, but it's not the same in terms of saying, okay, I'm going to open a new 100 million ton project and all these different expansions that they did last time. Because last time they had not only the RBA egging them on, saying this is going to last for a long time, but they didn't have Brazil sitting there with 100 million tons. Is coming back on. It's already pre-committed. It's already in progress, and it's already in train. It's just a matter of it, actually getting that production up and running. That's the that stopped people from doing it this time because it was they looked upon it as more of a temporary spike in prices. And so, take advantage of them, but don't go out and commit your future to vast new expansions.
And the follow-up question to that is from Vanessa. Well, $50 iron ore, how low will the Aussie dollar fall? Which, of course, is the corollary, isn't it, really?
Yeah. So, I mean, there's obviously lots of other things going on, but I would say on its own, if the iron ore price fell to $50, you're talking probably mid-60s. So 66, 67 cents, you'd probably say as a base case for just the iron ore price falling. It really depends on what else is going on at the same time. If we're back into having to cut interest rates, so if China goes through a genuine slowdown and Australia and that affects more than just that, it goes through other commodities, then the Aussie dollar's headed down to sort of low 60s, I'd say at least. Could be much lower. Don't know whether I think I saw Cookie Boy there with 35 cents, and also pitching as well. I think I saw him as well pitching that. Walk the Wall says the iron ore price going to $50. I'd say I think there's a reasonable chance it'll go to $50, but I'd have to disclaim again if China turns around tomorrow and says we're standing on the debt accelerator and we're going to spend as much as we can, then maybe it's going back to $200. So, based on the path at the moment, it looks to be going lower. So.
Yes, no, absolutely right. And a lot of uncertainties, as part of the point we've gone through this is to try and explain what some of those uncertainties are and why it is quite hard to make, firm calls. But there was a very interesting article that you published over on Nucleus Wealth, which I think it's worth just spending a bit of time on, right? Because there's this famous Case-Shiller index, right? Which basically a lot of people swear by. I'm going to just put that initial chart up, right? So there you go. This is the chart, right?
Yeah. So this is how it gets done. So basically, it's a 10-year average of inflation-adjusted numbers. So and compared to the current price. So the idea is, what I'm showing here is actually the last 10 years of earnings per share on the US S&P. And you can see they go through these big cycles. So they're basically saying, well, you don't want to take it right at the top and you don't want to take it right at the bottom. So let's do like a 10-year average. But then let's also adjust it for inflation because in 2011, we only earned $80 per share. But there's been 2% inflation every year since then or more. And so in today's dollars, that's closer to 100. And so let's do an average of inflation-adjusted numbers. And so that's quite a common one that people use. Especially value investors sort of swear by it. The unfortunate thing for the last 40 years is it keeps telling you the markets are overpriced and you shouldn't be buying it. And we've had one of the greatest bull runs ever. So what I wanted to, ran with the headline that Trump broke this measure, and he did in a way because he put through some tax cuts. And the issue with this measure is it sort of implicitly implies that because you're doing this average of earnings, it implies that you're going to go back to whatever the average tax rate was over the last 10 years. And the average tax rate had sort of 6 years of 35% taxes and 4 years of 21% taxes. And so that's the next slide I think I've got for you there, where I've gone through and made those adjustments. Oh, sorry, yeah. So this is showing you, that red line's the average to date, and this blue line's the cyclically adjusted PE, they call it, or the Shiller PE. And you can see that, since 1980, you had one chance to buy, and every other time it's basically told you it's too expensive.
So there's more going on that index might actually suggest, right? Which is why then the next one, right, which is that one. So Cape 2.0.
Cape 2.0. I also have a Cape 3.0. I'm going to bring out later on this week. But this has got the less contentious ones in there. So I've got a lot of other changes that I make to it. But I put the less contentious one. One is just saying, well, let's take a 10-year average of pre-tax earnings and then divide that by the current and then use the current level of tax. So so work out whatever the pre-tax profit was, 10-year inflation adjusted average, apply today's tax rate to it and use that instead. And then the second thing it does is there's been a lot of buybacks. Buybacks were illegal in the US pre 1982, and so but the amount of buybacks has been rising, and that actually biases this the equation within here. So you actually need to make an adjustment for the buybacks as well. And that brings the cyclically adjusted PE down about 25% in terms of the level. So it goes from being, at levels never seen before, well above, the 29 crash and all that type of stuff, back to levels where you go, look, it's still really expensive, but it's at least the distance to fall to get back to more reasonable levels is not as far as it used to be. The other thing is I've got the 3.0, we'll bring that down even a little bit further when I make some adjustments to there's a bunch of other technical ones. They're more controversial. There's a little bit more arbitrary assessment of how it should be done and what should happen. And so I make those changes, which makes a reasonable amount of difference to it. Not enough to make the market cheap. I think it would be foolish to try and argue that the current market's cheap, but I guess what it's saying is it might not have to fall as far as you think before it gets back to levels that are more reasonable.
Yeah, and that's the point, though, of course, with all of these indices and all these metrics to try and read what's going on, right? There's a bunch of assumptions. There's a bunch of logic which may or not be right. But as soon as you start questioning, chopping and changing, then what may look like an obvious signal in one direction could be something quite different.
Absolutely, and you do need to ask that question: what has changed? And one of the big factors that I am making adjustment for in the 3.0 one is accounting rules have changed. And so, a dollar of profit from 1980 is not the same as a dollar of profit from 2020. There's just different rules as to what goes into that dollar and what doesn't go to that dollar, and there's back in the 1960s, you could write up the value of your assets quite easily. So things would go badly, people would write their assets down, things would improve, they'd write their assets back up again. In today's parlance, you can't write it back up again. You can write it down. You're actually very heavily encouraged to write it down, which is an element of conservatism. So you have a pandemic, and everyone writes their assets down, and then the pandemic passes and goes, oh, actually, they go saying, oh, my asset was worth $100, now it's only worth $50, and they go, oh, actually, you know what? It is worth $100. I was wrong, but they can't write it back to $100, and so that sort of biases into the numbers now. So that'll affect that again. And make it a bit more, but as I said, not enough to make it cheap.
That's a whole new set of base effects.
Absolutely, yeah. And the base effects are everywhere now. I guess what I was saying to everyone is try and look for 2-year numbers as well as 1 year. 2-year average growth rates. So across every number I'm doing, it's always for me it's saying, okay, what's the 1 year growth rate? Great. What's the 2-year growth rate? To the power of to the square root of it to get it back to the right level, but because there's so many base effect weird things happened a year ago that you just need to get out of that data so you can get a much cleaner look at what's going on.
And just a shout out to a Canadian guy there who's basically said up here at 5 a.m. Welcome, it's good to see you on. Normally it's me who's doing stuff at silly times of the night because of the time down here. So it's interesting to see it the other way around. And Ben said Canada's better than Australia. Well, maybe it depends where you are, I suppose. Now, Cookie Boy asked...
that's exactly what we're saying. I've got a brother in Canada as well at the moment who's just talking all the stuff he's been up and doing. But it is that issue of saying they had a much worse time of it earlier on. But now they're in a much better place and things are a lot more normal and off and running. And that's exactly Australia has had the reverse. We've still got to pay the price at some stage, and hopefully the price will be a lot lower because we've had the chance to be vaccinated and all these things. But at some stage we will have to go through that reopening pain.
Yeah, and it's very interesting because I've done quite a lot of comparisons between the Australian property market and the Canadian property market, and there are some quite interesting correlations, right? A lot, debt's very high in both areas. A lot of money laundering going on in both areas. Right?
Lots of immigration in both.
Lots of immigration, exactly right. So it's quite interesting making comparisons. In fact, in many ways, I think the Canadian and Australian property markets are a lot closer than, say, comparing Australia with the US.
Yeah, absolutely. And the other thing is, Canada is a huge huge in the oil and gas within Canada, and it meant that and big in resources as well. But 20 years ago, there was a starker difference between Australia and Canada because Australia didn't have much oil and gas, but now we actually have stacks of gas. We're the world's biggest exporter of it, and most of that gas is at least related to an oil price. And so I do think even in terms of macro economies, Australia and Canada are a lot closer than what you would have thought 10, 15 years ago.
Absolutely. Now, here's one from Cookie Boy from a little while ago about should Australia adopt a government pension fund of Norway type fund to fund the nation's future, right? Because at the moment, we've got a lot of superannuation money sitting in the system, right? Close to, what, 3 billion now, which is nowhere near as much money as in the property, but it's a big number. And yet, a lot of it's not necessarily going to support or help or build infrastructure, which is a big black hole here.
Yeah. Okay. So let me be careful, I guess, about how I define this as well, because I do have I've got a lot of sympathy for the view of saying, we shouldn't be out there taxing people more just to take that money and store it away in an investment fund and then give it back to them in 10 years' time. So that part, I think, well, no, just tax them less, and if you need the money in 10 years' time, tax the people that are there at the time. What I do think from the Norway fund is we should be taking, when we get temporary windfalls, in particular for the resources side, that stuff we should be storing in a fund that we then drip out. So when an iron ore price hits $200 and we're getting these record royalties flowing in to Australia, we should be taking that money, storing it away, and dripping that out over a 10-year period. That would make sense. I think, was it Cookie Boy coming up there with the comment about saying they've got lots of free services and higher taxes. I'm fine with that, but you're saying that's if you're taxed higher now and you're given more services for it, that's great. If that's what people want and people are happy to accept it, then great. I'm more than willing to give it to them. But what I'm saying is I don't want to see is what I think some of the New South Wales governments was a little bit responsible of recently, of saying, here's this money we could use to pay off debt or give back to shareholders or charge them less in tax. What we'll do instead is we'll go and invest it in shares and equities, and we'll make all this extra return for it and then give it back to people later. Is saying, well, that's not your job. I'm more than happy to say higher taxes, better services, but don't take money from people just to invest it and then give it back to them.
Yeah, and I actually agree with you. That whole concept of if there's a windfall, don't just hand it back in taxes, right? Which is, of course, precisely what Howard did, right?
Absolutely.
And then we had a hole which they had to try and plug, right? So taking a more strategic view. But actually the problem there is taking a more strategic view is beyond the political cycle. And most decisions in Australia are taken within the political cycle, and thereby hangs probably one of our biggest problems.
Absolutely, because the problem is, if you put that money away, that other politician party, whichever side you're on, that other guys will get in there and they'll spend it, and we got to get in there and spend it before they have the chance to. Is I think the way.
Well, and of course, then you actually take it one stage further and say, well, in that case, I'll fund a few car parks, never mind whether there's a station close by or something, right? Because basically I want to make sure that I get re-elected again, so that the money gets deflected, and unfortunately it doesn't go to what perhaps purpose it should go to, but it goes through to sort of more tactical re-election funds and things like that. So that's part of the process. Yes. But anyway, so answer, Cookie Boy, was yes, I would, but for certain things. Yeah, fair enough. Now, Cookie Boy has been hot on the questions as well. Are you sticking with your inflation call? Or let's remind everybody what your inflation call is, and are you still standing by it?
Yeah, look, I still think it's transient. I've got a chart up. I've got a chart which I show quite frequently, which is I think it's the Atlanta Fed runs like a sticky prices versus non-sticky prices. So in the sticky prices, all the things that don't change very often, whether it's rent, healthcare, school fees, those types of things. And then the other one, the transient inflation, I can't remember what they've got a different term for it, is all your sort of your fuel or your groceries and things like that. And so within those ones, what happens is that the sticky prices have actually turned down in the latest reading. So not only do they never rise, they fell a little bit, a tiny bit, rose a tiny bit, and now they've actually looked like they're rolling over, whereas the transient ones are still sort of rocketing up. So, and when you look in, and I'm talking about US stats here, mainly because the Australian stats are so far behind. Honestly, I've got no idea whether they're right or not. Actually, not actually. Sorry, I do have an idea. I know they're not right because they only come every 3 months, and by the time they roll around, we're in lockdowns, we're out of lockdowns, we're doing stuff. The stuff that happened at the start of the 3 months is no longer relevant for the end of the 3 months. So yes, I'm talking about the US data here. But the US, the other thing is that so the places you're still seeing it are things like used cars and things like hotel rooms and airline flights and all these things like that that are all sort of bouncing back to prior levels. So I'm not to say that it won't come, but I think the inflation, the wages is is the key place where I'm watching for that. And in the latest performance report, I wrote this up a bit, but very much wages is where if I'm wrong and inflation does start reoccurring, I think we'll see quite considerable wage growth. But to date, we haven't seen that. So
I'm not holding my breath for wages growth, and I have a view that actually real inflation will only be seen when wages do start to move, and I don't think there's much chance of that. I mean, the Reserve Bank's saying for the next 2 or 3 years, forget any wage increases beyond, and particularly now, of course, with the more cyclical process with regard to lockdowns and the extra debt being incurred to try and keep things ticking over. Meanwhile, makes go on.
On one side of that's the public sector, which is got record low wage growth.
Yep.
So we've never had lower wage growth, in the recorded in the amount we've recorded in terms of the public sector, and so you've got one hand the RBA saying we need to get out there and raise wages, and on the other hand you got the federal government saying no, wages need to be as low as possible.
Correct. Well, I think the wages increases in the RBA itself are very low, so it's interesting. On one hand, they're saying we need higher wages. On the other hand, they're not following through. So it really is quite fascinating.
We will define that for the way the RBA, their note printing. Yeah. I suspect they'll probably, well, actually, we won't what they're doing with their own salaries.
Well, we're coming towards the end of the show. I believe you guys won an award. Is that right?
Yes, we did. Yeah, thanks. I had mentioned on my list of things to try and work that into the conversation slowly somewhere. But yeah, we won an innovation award, which was very, very heartening to see. So we've been a finalist, I think 4 times. This is our 4th time at fourth go at it, and we finally got the win for that. So this is in IMAP. It's the Institute of Managed Account Professionals. And so what it's really tracking is we're doing some quite innovative things, we think, within managing portfolios where people can come in with $10,000 and we sort of start with more using exchange traded funds, and as they get more money in there, we gradually start replacing it with shares. At each stage of the way, we let you screen out. We've now got about almost 40 screens, I think, where you can screen out whether whole sectors, or you screen out tobacco or gaming or nuclear, whatever it is that sort of concerns you. So that it really lets you have a nuanced view of it. I think there's a part for a lot of people where you think, well, you might feel strongly about climate change and think, I really do want to try and do something about climate change. But then you look at a green or an ethical portfolio, and it doesn't have gaming, it doesn't have tobacco, it doesn't have alcohol, it doesn't have all these things that you might actually be saying, well, you know what, I actually drink a lot of alcohol myself and do some gaming. I'm happy to take those within it. So what we're really trying to do is give people a nuanced view where they can actually say, no, just cut out that very small part that I really have concerns with and leave those other products in the portfolio.
Well, that's interesting, and one of the reasons to underscore again why the link up with what the world is, because the transparency and flexibility that you've got through your techniques and tools is remarkable compared with most of the other entities around there who basically got this black box. You know quite what's going on, and I mean, obviously scrutiny is painful, but it's also powerful.
Well, absolutely. We just had a few people here calling me out on what we're doing with stocks and looking at the trading with it. And so, yeah, it's sometimes there's things you'd sort of like to sweep under the carpet. But, the idea was that we've got it all out there and all out and open so that you can really see what's going on. there was a question. Sorry. The other thing is, what you're saying about the structure of it. I sort of feel in a way the investment industry is set up to say, look, you can have a Ford that's black if you want, and that's it,
Yes.
or you can go and build your entire car yourself up from scratch. Here's all the pieces. Go and put the whole thing together. And what we're really trying to do is say, well, no, actually, we would. We'd like to have a car that's running, and it's got airbags, and it's got an engine in it, and it's running. Everything's running properly. And then if you want to add leather seats or fluffy dice, or change the color, or have a soft top or a hard top, whatever it is, you can do that within the, without having to build the entire car yourself from scratch.
I like the idea of the floppy dice fund.
That's right.
Yeah, the mind boggles. No, but it is important, and hats off to you guys for figuring it out and being able to actually navigate these choppy waters. Because I think, if anything, standing back and thinking of our conversation over the last hour and a half or so, right, things are very complicated at the moment, right? There are lots of uncertainties. There are lots of what ifs. There are lots of it depends. There are lots of uncertainties too with what the central banks around the world are going to do. And yet, of course, your job is to navigate a path through it, right?
Yes.
Get some reasonable performance on the way through, but also risk protect if, in fact, one of the other things happen. That's not simple.
No, that's right. And there's always the concern, we've been taking a bit off the top, and maybe a whole bunch gets thrown in and markets run off again. So it is trying to weigh up that risk and return. But a large part of it for me is having that transparency, so that we were speaking to people the other day who didn't agree with our view. But that's it. We feel as if that's a good thing that we've identified that nice and early. They can either then go and invest in. We have some passive portfolios where we're not taking any assessments or other things they can do, or they can just take their money to another manager where they agree with it. But for me, that's an important reaction, because we've been so transparent that that client is actually getting what they're looking for. They're not throwing their money into a fund and finding out 6 months later that, hey, I thought the market was going to do this, and the investment manager invested in something completely different, and I never knew because they didn't tell me. They found out from day one, this is what we're doing and this is how we're applying the money, and they were sort of, they're not comfortable with that. We'd say, well, here's either an alternative or a chance to go and stick your money somewhere else.
Absolutely.
And hopefully come back when they do agree with what we say.
Well, exactly. Now, I have one last question which I want to ask you. But Morgan Stanley, I think it was, announced that they'd actually taken a large share of a crypto fund to be able to provide effectively packaged investments into the crypto market for some of their clients. They'd sort of basically package it up, and they're charging 2% a year or something to do it, right?
Right.
To what extent do you think crypto investing is going to become mainstream or not over the next 2 or 3 years? Or is that just an aberration on behalf of US investment banks? What do you think?
I hope it isn't. Sorry for anyone who's a crypto investor out there. Look, I think of it as, to me, it's a game. You're playing a game against other investors. That's all you're doing. So hats off to the people if you're winning. But for me, I sort of feel as if investing is the wrong term to put on it. I sort of feel as if when I see people talking about the price of Bitcoin going up and down, pasted on the end of the financial news, I sort of wish they put it when they were showing the sports odds or something like that instead, or the lotto winners. So I hope it doesn't. But it's obviously got a lot of momentum behind it, and there's a lot of if it didn't, I wouldn't say it would be the most surprising thing ever if it did happen that it became part of it. But I do think in the longer term, other things will rise that will be and where this comes from, without wanting to spend a whole another hour talking about it. And I have got some podcasts people can listen to, if you're interested in my further views, is really that it's about the regulation side. What crypto really is a private type of money, and there's been lots of different types of private money. Frequent flyers are a private type of money out there. Disney dollars are a private type of money. The issue is governments really like to be the monopoly issuer of cash. It really lets them do a lot of things that that they like to do in terms of running economies and all that type of stuff. And if crypto gets too big, then they will need to regulate it so that it doesn't become too big. And the other thing is that, the other irony I find is that, all these freedoms that cryptocurrency was going to give to people in terms of, the anarchist view about this will help, it's not tied to any government and all that type of stuff. I very much note that the Chinese government has taken basically a lot of those and are turning it into perhaps the ultimate in terms of actually Big Brother watching everything you're doing and giving you social scoring points for whatever you're spending your money on or not spending your money on. So it would be it's not a pleasant thought, but the irony is what was thought to be going to provide all this freedom and anonymity is quite possibly going to be a tool of state oppression.
Yeah, absolutely. Well, of course, China is the the leading example of how this all gets integrated right into the digital world through the control and cameras. They're even now suggesting that they're going to allow people only to go online at certain times of the day to do certain things if you're a certain age. All those. I mean,
yes,
this is. Yeah, exactly right. Yeah. So it shows you how control can really become the center of it. And once you've got those controls in place, then you can never unwind it probably. So that's an issue. But
and I will say though as well, cryptocurrency in itself, I don't have a problem with. I think there's some great technology things, and that's, as I said, that you can see how China's looking to use it. In our latest batch of stimulus or some of the state government stimulus you're doing, you can absolutely see where a digital currency where you said to everyone, rather than log onto a website to get some sort of voucher or something to go tourism in Australian regions, you could actually say, here is some money stuck in your crypto account.
Yep.
You're only allowed to spend it, but it's free money, but you're only allowed to spend it holidaying in regional Australia or regional Victoria or whatever, wherever you're looking to spend it. You can see there's great uses for it, but that's not Bitcoin.
No. But and then you say, but you've got to spend it within a month or 3 months, otherwise it devalues or disappears, right? I mean, that's the and my model for the future is ultimately central bank digital currencies will be part of the story of how they do that, right? Because if you've got a central bank digital currency and you've got an account at the central bank, then they can put money directly into your account for you to use, and they can attach conditions and what have you to it to be able to actually push the money into what they want it to do, right? That's the that's the scary future.
And but even if it's not that far, I mean, I would love to see today. I mean, I've said this is my ideal for the for monetary policy in Australia is that you actually have a higher minimum interest rate. Whether the minimum interest rate isn't 0, it might be 2% or something like that. But you actually give the you give the RBA the chance to print money, and rather than giving it to banks or government or by government debt, is actually give it directly to everyone as taxable income. So that means poorer people get more than richer people. Great, and it also means the government gets more money, so they can take they've got some more tax coming in. They can go out and build more things if they want, and just let the RBA just increase the amount. But that's not coming anytime soon. So that's the when yeah, that's the Klassen wish for monetary policy. But it's along those same lines of giving money directly. But I guess the main thing is, I guess where I'm coming from that perspective is the RBA printing money and buying government bonds or giving it to banks as cheap funding doesn't get it out to everyone. It just inflates a lot of these prices. It's great when interest rates are falling from 7 or 8% all the way down to 2%. But once they start falling below that, all we're doing is inflating asset prices.
Absolutely. Well, I think we'll come back and perhaps revisit this context of, economic resets, all those sorts of things. There's a big story here which we can't really touch on. But I will just make one final point with regards to those crypto funds that some of the big investment banks in the US are pushing, right? It's amazing to me how the crypto community themselves have said, see, those guys are making it all legitimate, right? And there's a lot of that, I think, going on at the moment. So what I say to people is just read the small print, right? 2% a year in fees, right? Who's making the money? Who's making the money?
But this is meant to be a cash type asset, though, isn't it? Like it's meant to be, it's meant. Bitcoin is meant to be money, so it's meant to be this stable form.
Yep.
if you can give me your money and I'll take 2% off if you really want to. Like
Exactly.
I'm happy to do it. I'll stick it in cash and I'll give you I'll charge you 2% fee if that's what you really want.
Exactly.
But it's sort of beggars belief, and it's that point about it's a lottery asset. People are treating it as a lottery asset.
Yeah, absolutely.
I'll pay 2% to play the game.
Excellent. Well, we've hit our deadline once again. So, Damien, I really want to say,
out of tapes.
yeah. Well, I turn to a pumpkin at 9:35. So, I want to say thank you very much once again for sharing your time and your thoughts. Very fascinating conversations, and we didn't get to all the questions, but hopefully we got to a few of them. But I think people hopefully got a bit of a sense of some of the uncertainties that are out there, which is part of what I wanted to do today. And I'm hoping you can come back in the end of September, and we can do it all again and see whether in fact the markets are going up, going down, going sideways, or whatever.
That's
So
right. We'll both be out of lockdown by then. It'll be nice and sunny.
I'll keep my fingers and toes well and truly crossed.
I don't think it'll make it fun.
No, indeed.
I hope it does. But...
Yeah, well, we'll take it one day at a time. Damien, I appreciate your time. Thank you very much indeed. And have a good evening. I'm going to take you offline and I'll just close out the show. And we'll look forward to catching up with you next time. Thank you once again.
Sounds great.
See ya. There you go. So that's big show tonight. A lot of interesting thoughts and a lot of powerful ideas, hopefully. Hope you enjoyed that. I just want to say that next week it's just me talking about household surveys, mortgage stress and all that sort of stuff, latest survey data. There's a lot of really interesting stuff coming out from my survey, so I'll share that with you on the show next week. So mark your diary, Tuesday evening, next on the 7th of September. Other than that, I think we're done for tonight. I want to say thank you very much for all of your questions, the discussions in the chat, and for all of the attendance tonight. Good to see so many on. And I look forward to seeing you next week. This is Martin North from Digital Finance Analytics, signing off. Keep safe. See you soon. Bye.